They crashed the price of silver on purpose, and then they bought $140 million worth of it at the bottom in one single day, while you were panicking, while social media was screaming that silver is dead, while every analyst on television was telling you to sell. The same institutions that caused the crash were on the other side of the trade writing checks for $140 million to take delivery of physical metal. And I have the data to prove every single word of that. Silver was sitting at $96 on Monday. By Tuesday, it had crashed to $77. That is a 20% drop in 24 hours. During a war, during the Strait of Hormuz being shut down 70%, during the most unstable geopolitical environment we have seen in decades. And somehow, in the middle of all of that chaos, silver drops 20% in a single day. Now by Thursday, silver bounced back to 84. So in 3 days, silver moved from 96 to 77 to 84. That is a $20 range in 72 hours. In a normal market, silver moves $2 or $3 in a week. This market moved $20 in 3 days. And most people are looking at that and feeling confused. They are looking at the red candle and feeling fear. They are looking at the green candle and feeling relief. And they are missing what actually happened underneath the surface, because what happened underneath the surface is the most important story in precious metals right now. And it is a story that nobody else is telling you because nobody else is pulling the actual data. Before I go any further, I want to ask you something. Right now, as you are watching this video, what time is it where you are, and where are you watching from? I want you to drop that in the comments. Tell me the time and tell me the city or country. I ask because this channel has grown into something global, and I want to know who is watching and when. It helps me understand this community. So drop your time and location in the comments right now before you forget. Now let me tell you what this video is going to cover, because I do not want you to miss a single piece of this. I have 3 blocks of data that I have never presented together in a single video before. And when you see all 3 together, the picture becomes so clear that you will never look at a silver crash the same way again. Block 1, the delivery data. I am going to show you exactly who bought silver during the crash. Names, contract numbers, dollar amounts, $140 million in one day. And I'm going to show you that the same institutions whose analysts were publishing bearish reports were simultaneously taking delivery of tens of millions of dollars worth of physical metal. The contradiction is so blatant that once you see it, you cannot unsee it. Block 2, the vault data. I'm going to show you that nearly 3 million ounces of silver were pulled out of the vaults in a single day, vault by vault. I will break it down. I will show you which vaults lost the most metal. I will show you how the registered silver supply, the silver that is actually available for delivery, is shrinking at a rate that should be making headlines but is not. Block 3, the open interest data. I am going to show you that the total number of outstanding silver futures contracts just fell to the lowest level since 2013, the lowest in over 12 years. And I'm going to explain why that number matters more than the price itself, because when you understand what open interest tells you about who is left in the market, you understand exactly where the price is headed next. And at the end of this video, I am going to connect all 3, the deliveries, the vault drain, the open interest collapse, and I'm going to show you a pattern that has repeated 3 times in the last 20 years, 2008, 2020, and now. Every single time this pattern formed, the same thing happened afterward. And if history is any guide, what is coming next is going to catch most people completely off guard. But I need you to stay with me through all 5 sections of this video, because each section builds on the one before it. If you skip ahead, you will miss the context. And context is everything when you are reading this kind of data. So do not skip. Do not fast forward. Watch this the way I built it, section by section, data point by data point. And by the end, you will have a complete picture that less than 1% of silver investors ever see. Now here's why I say they crashed silver on purpose. I am not saying that lightly. I am saying it because the data supports it. When silver was at $96, the leverage in the futures market was at extreme levels. Traders were piled into long positions with borrowed money. The margin requirements on those positions were already stretched thin, and all it took was a coordinated push lower to trigger the first wave of margin calls. Once the first margin calls hit, the cascade began. Forced selling triggered more forced selling. Longs who could not meet their margin requirements had their positions liquidated automatically, and every forced liquidation pushed the price lower, which triggered more margin calls, which triggered more forced liquidations. Silver did not fall from 96 to 77 because the fundamentals changed. Nothing changed. The war did not end. The supply chains did not get fixed. The Strait of Hormuz did not reopen. Silver fell because the paper market structure broke under the weight of its own leverage. and someone knew exactly how much pressure it would take to start that cascade, that is not an opinion. That is how margin call mechanics work. And the question you should be asking is not why did silver crash? The question is who was waiting at the bottom with $140 million ready to buy? That is what I am about to show you. Pull this up on screen. This is the clearing daily delivery notice for silver futures. Business date, March 3rd. Settlement price, $82.93 per ounce. Each contract represents 5,000 ounces of physical silver. That means each contract at that settlement price is worth approximately $414,600. Now look at the two columns, the issuing side and the stopping side. Issuing means selling. Stopping means buying, taking delivery, saying, I want the physical metal, not the paper contract. Give me the silver. On the issuing side, one major institution issued 400 contracts. Another issued 200. They were selling. On the stopping side, here is where your jaw drops. One major bank stopped 195 contracts. Another stopped 145, another 65, another 62, another 50, another 60. Total for the day, 607 contracts standing for delivery. Month to date, 5,694 contracts. That is 28.47 million ounces of physical silver standing for delivery in March alone. Now let me translate those stopping numbers into dollars because that is when this gets real. The bank that stopped 195 contracts, 195 times 5,000 ounces times 82.93. That is $80.7 million, $80 million of physical silver purchased in a single day at the crash price, not at 96, where silver was on Monday. At the bottom, at the exact bottom, the bank that stopped 145 contracts. Same math. 145 times 5,000 times 82.93. That is $60.1 million. $60 million of physical silver purchased in one day, again at the crash price. Combined, those two institutions alone bought $140 million worth of physical silver on the day of the crash. $140 million. Let that number sit in your brain for a second. Now, I want you to think about something. If you genuinely believed silver was going lower, if you genuinely thought the crash was just the beginning, if your own research told you that silver was headed to 70 or 60 or 50, would you spend $80 million buying it? Would you write a check for $60 million to take delivery of the physical metal? Nobody does that. Nobody spends $140 million on an asset they believe is going to be worth less tomorrow. That is not how institutions operate. Institutions do not gamble $140 million. They spend $140 million when their internal models tell them the asset is undervalued and they want to own as much of it as possible before the market figures out what they already know. And here's the part that should make you furious. One of those same institutions has an analyst report out right now. Published. Public. That says silver will average $81 an ounce in 2026. $81. Their analysts are telling the public that silver is going to 81, while their trading desk is paying 83 to take delivery of physical metal. If they believed their own analyst report, if they actually thought silver was headed to 81, why would they pay 83 today? Why would you buy something for 83 that your own company is telling the world is going to 81? The answer is you would not. Unless the analyst report is not designed to inform you, unless the analyst report is designed to keep you selling, so the price stays low enough for their trading desk to keep accumulating physical metal at a discount. Read that again. Their analysts say sell. Their trading desk says buy 140 million. Those two things cannot both be honest. One of them is the real strategy. The other is the public narrative designed to support the real strategy. And the delivery data tells you which one is which. This data is public. It is right there on the exchange website for anyone who wants to look it up. The problem is 99% of retail investors never look it up. They read the analyst report, they see the price target, they sell, and their metal ends up in the vaults of the institution that told them to sell in the first place. Now let me zoom out from one day because one day of data could be an anomaly. But this is not one day. When you look at the delivery data over the past 6 months, the same institution has been stopping contracts consistently every single month. They have been taking delivery month after month after month at $100, at 90, at 85, at 77. They are not timing a bottom. They are accumulating on a schedule. And that tells you their internal price target for silver is significantly higher than where it is trading right now. Because you do not accumulate an asset for 6 consecutive months unless you believe the price is going dramatically higher. The total delivery number for March so far is 28.47 million ounces. Let me put that in perspective. 28 million ounces standing for delivery in the first 3 days of March. That is an enormous number. That pace, if it continues, would represent one of the largest delivery months in the history of the silver futures market. And this is happening during a crash, during a 20% price drop, during a day when retail investors are selling everything they own because they are terrified. The institutions are not terrified. The institutions are loading trucks with physical silver and driving them out of the vaults. That brings me to the vaults. Because the delivery data only tells you half the story. The vault data tells you the other half. And what is happening in the vaults right now is something I have never seen at this speed. Pull this up on screen. This is the Silver Depository Report, activity date March 3rd, the same day the institutions bought $140 million worth of silver. The same day silver crashed to 77. Look at what happened in the vaults on that exact same day. Nearly 3 million ounces of silver were removed from the vault system in a single day. Let me break it down vault by vault because I want you to see this with your own eyes. One major depository lost 800,000 ounces in one day. 800,000 ounces walked out the door. Another depository lost 883,000 ounces. A third lost 600,000 ounces plus another 379,000 adjusted out of registered status. A fourth depository lost 603,000 ounces. Vault after vault after vault. Silver pouring out of the system, not trickling, pouring. Add it all up. Total registered silver dropped 841,998 ounces to 87.1 million ounces. Total silver in all vaults dropped 2,953,965 ounces to 352.2 million ounces. Nearly 3 million ounces gone from the vaults in one single day. Now let me explain why this matters. And I need you to really understand this because this is the piece that most people miss. There are two categories of silver in these vaults. Eligible and registered. Eligible silver is silver that is sitting in the vault but is not available for delivery against futures contracts. It is privately owned, it is just being stored there. Registered silver is the silver that is specifically earmarked and available for delivery. When someone stands for delivery on a futures contract, the registered silver is what gets used to fulfill that delivery. When registered silver drops, the pool of deliverable metal is shrinking. The actual supply of silver that can be used to settle contracts is getting smaller. And when that number drops while delivery notices are surging, you have a situation where demand for delivery is rising while the supply available for delivery is falling. Think about that dynamic. More people want the metal. Less metal is available. In any market, in any asset, in any economy on Earth, that dynamic leads to one outcome. The price has to rise to balance the equation. There is no other way to resolve rising demand and falling supply except through higher prices. That is not an opinion. That is the fundamental law of supply and demand. But here's the disconnect that makes this situation unique. The paper price crashed 20% on the same day that 3 million ounces left the vaults. The paper market is saying silver is worth less. The physical market is saying silver is so valuable that 3 million ounces are being pulled out of the system in 24 hours. Both of those things cannot be true. One of them is lying, and the delivery data tells you which one. Now, I want to put the vault drain in historical context because the speed of what is happening right now is not normal. Over the past 12 months, the silver vault system has lost over 100 million ounces. 100 million ounces. That is roughly 25% of all the silver that was in those vaults a year ago. Gone, moved out, taken delivery of, shipped to refineries, shipped overseas, shipped to private vaults. The metal is leaving the system, and it is not coming back. And the rate of withdrawal is accelerating, not slowing down, accelerating. The withdrawals we are seeing now, 3 million ounces in a single day, are larger and faster than anything we saw 6 months ago. The trend is speeding up, and the total registered silver is now sitting at 87 million ounces, which is one of the lowest levels in years. Let me do some simple math for you. If the current delivery pace continues through March, and there are 28 million ounces standing for delivery in the first 3 days alone, we could see total March deliveries approach or exceed 100 million ounces, against a registered supply of 87 million ounces. Read that again. 100 million ounces potentially demanded, 87 million ounces available. The math does not work. Something has to give. Either deliveries slow down, which means the institutions stop buying and there is no evidence of that. Or more silver gets moved into registered status, which means pulling from eligible reserves, which depletes the total even faster. Or the price has to rise high enough to attract new supply into the system. This is the physical market tightening in real time. This is not theoretical. This is not something that might happen in the future. This is happening right now, today. On the same day the paper price crashed 20%. The disconnect between What the paper market is telling you and what the physical market is telling you has never been this wide. The paper market says sell. The physical market says there is not enough metal to meet demand. One of these is going to be proven, right? And I know which one I would bet on because paper contracts can be created infinitely. Physical silver cannot. You cannot print silver. You cannot create it with a keystroke. It has to be mined from the ground, refined, transported, and delivered. And right now, more of it is being demanded than is available. That is the reality that the paper price is not reflecting, but it will, because physical reality always wins in the end. Always. The only question is timing. And that brings me to the third piece of data, open interest, because this is the piece that tells you about timing. And what it is saying right now is something I have not seen in over 12 years. Pull this up on screen. This is the final data from the exchange for Tuesday, March 3rd. Total silver open interest dropped to 113,326 contracts. That number means everything because it is the lowest open interest reading since September 30th, 2013. The lowest in over 12 years. Now let me explain what open interest is, because if you do not understand this number, you cannot understand what is happening in the market right now. Open interest is the total number of outstanding futures contracts that have not been settled or closed. Every futures contract has a buyer and a seller. When both sides open a new position, open interest goes up by 1. When both sides close their positions, open interest goes down by 1. When open interest drops sharply, it means traders are leaving the market. They are closing positions. They are walking away from the table. And when open interest collapses to a 12-year low during a price crash, it tells you something incredibly specific about who is left and who is gone. The leveraged longs are gone, wiped out, liquidated. The traders who were borrowing money to bet that silver would go higher have had their positions forcibly closed. The margin calls I described earlier did their job. Every weak hand that was going to be shaken out has been shaken out. Every leveraged position that was going to be liquidated has been liquidated. The speculative excess that built up during silver's run from 70 to 96 has been completely flushed from the system. And what is left is a market that has been cleaned out, stripped down to the studs. The only participants remaining are the ones with the deepest pockets and the strongest convictions. And the delivery data tells you exactly who those participants are. The same institutions that bought $140 million of physical silver at the bottom. Now here is why the open interest number is so critical for what happens next. I want you to think about this carefully because this is the most important analytical framework I can give you. When open interest hits extreme lows during a crash, it historically marks the end of the selling pressure. Not the beginning, the end. Because there is nobody left to sell. The longs who were going to get stopped out have already been stopped out. The margin calls that we're going to hit have already hit. The forced liquidation has already run its course. The selling pressure is not building, it is exhausted. Now combine that with what I showed you in the first two sections. The institutions are buying $140 million at the bottom. 3 million ounces are leaving the vaults in a day. And the open interest is telling you the sellers are gone. Buyers are aggressive. Supply is tightening. Sellers are exhausted. That is a coiled spring. That is energy compressed to its maximum density, waiting for a trigger to release. Let me show you what happened the last 3 times this exact setup formed, and I mean exact. Same open interest collapse, same institutional accumulation at the lows, same physical market tightening, 2008. Silver crashed from $21 to $8. Open interest collapsed. Institutions accumulated physical metal at the bottom. Vaults tightened. Everyone said silver was dead. And then silver ran from $8 to $49. A 600% move. 2020, silver crashed from $18 to $12 during the initial panic. Open interest collapsed. Institutions took delivery at the lows. Vaults began draining. Everyone said silver was finished. And silver ran from $12 to $30. A 150% move. Now, 2025. Silver crashed from 96 to 77. Open interest collapsed to a 12-year low. Institutions bought $140 million of physical at the bottom. 3 million ounces left the vaults in a single day. Everyone is saying silver is going lower. Do you see the pattern? It is the same setup. Every single time. Crash. Open interest collapse. Institutional accumulation. Vault drain. Bearish sentiment. And then an explosive move higher that caught everyone off guard. I am not telling you this to make a prediction. I am telling you this because the data is showing you a pattern, and the pattern has resolved the same way every time it has appeared. Not sometimes, every time. Now, I want you to understand something about why this pattern works the way it does, because it is not magic, it is mechanics. When the crash happens, the metal changes hands. It moves from leveraged speculators who cannot hold their positions into the hands of institutions who are happy to buy at discounted prices. That transfer of metal from weak hands to strong hands is the entire purpose of the crash. The crash is not the destination, it is the mechanism. It is how the market moves metal from the people who cannot afford to hold it to the people who want to hold as much of it as possible. And once that transfer is complete, once the weak hands are gone and the metal is sitting in institutional vaults, the market reprices because the institutions are not going to sell at 84 what they just bought at 77. They did not spend $140 million to make a quick trade. They spent $140 million because they believe the value is significantly higher. If you are watching this video and you are subscribed to this channel, then you understand why I track this data. And if you are watching and you are not subscribed, hit the subscribe button right now. Because what I cover on finance currency is the data behind the headlines, not the opinion, not the hype, the actual numbers that tell you what is really happening. Subscribe and hit the notification bell because when the next move starts, you want to see it in real time. Now let me connect everything and explain why this volatility exists and who it is designed to benefit. Because this final section is the one that changes how you see every future crash in this market. I promised you at the beginning of this video that I would explain why silver crashed 20% in one day and then bounced $7 in 2 days. Why the volatility is so extreme it feels like the market is trying to drive you insane. Here's the answer, and it is simpler than most people think. The volatility exists to transfer metal. That is it. That is the entire game. Every crash, every bounce, every whipsaw, it all serves one purpose: moving physical silver from the hands of people who react emotionally to the hands of people who accumulate strategically. Let me walk you through the psychology because once you see it, you will recognize it every single time it happens. Silver is at 96. Retail investors are excited. They are bullish. They are holding. They are posting on social media about silver going to 150. Confidence is at its peak. Then the crash hits. 96 to 77 in 24 hours. 20% gone. The excitement turns to terror. Some people sell at the bottom because they cannot take the pain. Others hold, but they are shaken. Their confidence is destroyed. They are not bullish anymore. They are just hoping to get back to even. Then the bounce comes, 77 to 84. The people who held feel relief. They survived. But their psychology has fundamentally changed. They are not thinking about 150 anymore. They are thinking about getting out alive. So when silver dips to 80 or 79 on the next pullback, they sell because they do not want to go through 77 again. They sell at 80 because the crash taught them that pain can come fast and it can come hard. And that sell at 80 is exactly what the institutions need. More metal changing hands at lower prices. More physical silver flowing from retail accounts into institutional vaults. The crash did its job, not by moving the price lower permanently, but by changing the psychology of the people holding the metal. That is the trap. The crash is not designed to send silver to zero. The crash is designed to change your behavior, to make you sell something you would have held if the crash never happened. The institutions do not need silver to stay at 77. They just need it to visit 77 long enough to scare you into selling. Once you sell, the price can recover because they got what they wanted, your metal. Every pump you see is not necessarily the top. Every dump you see is not necessarily the bottom. They are moves inside a range. And the range exists to shake out as many retail holders as possible before the real move happens. Silver right now is trading between the low 70s and the mid 90s. That is a $25 range. And every swing inside that range is doing the same thing, transferring metal. 77 shakes out the weakest hands. 96 shakes out the people who bought at the highs and sell when it comes back. Each cycle removes more retail from the market and concentrates more metal in fewer and stronger hands. And when that process is complete, when the open interest is washed out and the vaults are drained and the institutions have accumulated what they want, the price leaves the range, it breaks out, and it does not come back. That is not a theory. That is what happened in 2008. That is what happened in 2020. The range, the shakeout, the accumulation, the breakout, same sequence, same mechanics, same result. Now let me tell you what I think this volatility is building toward. And I want to be very clear. I do not give financial advice on this channel. Finance currency is about data analysis and education. What I'm about to say is my analysis based on the data I just showed you, not a recommendation. The range that silver is in right now, the 70s to the 90s, is not the final range. It is the loading zone. It is where the transfer of metal from weak hands to strong hands happens. And the data suggests that transfer is accelerating. Open interest at a 12-year low tells you the weak hands are almost completely gone. Vault drains of 3 million ounces a day tell you the metal is moving fast. Delivery notices of 140 million in a single day tell you the institutions are buying aggressively. When all of that converges, when the sellers are exhausted and the buyers are aggressive and the supply is tightening, the range breaks. And based on every historical parallel I can find, it breaks to the upside. And the move that follows makes the previous high look small. Now, I want to leave you with this because I think it is the most important thing I can say in this video. Do not watch the price. Watch the data. The price is designed to trigger your emotions. It is designed to make you feel fear at the bottom and greed at the top. And both of those emotions lead to the same outcome. You make the wrong decision at the wrong time. The data does not lie. The delivery notices tell you who is buying. The vault reports tell you where the metal is going. The open interest tells you who is left in the market. When all three of those data points align the way they are aligned right now, the conclusion is not ambiguous. It is clear. The crash was not a failure of silver. The crash was a feature of the market. It served its purpose. The metal changed hands. The weak got weaker. The strong got stronger. And now the market is sitting at a 12-year low in open interest with vaults draining at historic speed and institutions accumulating at historic volume. What happens next is up to the market. But the pattern is clear, and it has never been wrong. Before you leave, I want to hear from you. Drop a comment right now. Tell me what time it is where you are and where you're watching from. Tell me if you think the 77 low was the bottom or if there is more pain ahead. I will read every comment. I will pin the best analysis. And if this video changed how you understand the silver market, share it right now. Send it to one person who needs to see this. The data I showed you today took hours to compile, and most people will never see it unless you share it. Go watch the last 4 videos on finance currency if you have not already. The war escalation, the resistance call, the crash mechanics, and now this one. They build on each other, and together they give you the complete picture of what is happening in precious metals right now. This is finance currency. Follow the data, not the noise, not the analyst reports, not the social media panic, the data. It is all there. You just have to know where to look. I will see you in the next one.